Mr. Schiller, the creator of the Case-Shiller Index for real estate tracking, wrote this essay on the wealth impact of the stock market versus the home market. Even though this is an older piece, the conclusion is interesting. It's easy to find by searching wealth effects of housing versus stock market, but that's just because it's a well-read piece, so stress the end. Welcome to Financial Fluence. In this video, I'll tell you why the Fed must force a housing depression. Let's now get going. We find no evidence of a stock market wealth effect when we investigate this. Remember that the Federal Reserve encourages customers to spend less money because less demand means less inflation. When the economy slows, people lower their prices to entice people to buy again. That produces disinflation. Inflation ceases, and the Fed's tightening regime ends. But the Federal Reserve will undoubtedly know that a stock market crash hurts us. And it makes sense that there is a wealth effect when stocks fall. So those who lose money spend less. According to this study by Mr. Schiller, Yale, and other experts, the housing market has a greater impact on individual spending than the stock market. This is somewhat surprising given Jerome Powell's counsel to homeowners. He advised prospective buyers to wait until the reset. I'd say you need a reset, whether you're a home buyer or a young person looking to buy a property. We need to get back to a point where supply and demand are in balance, inflation is low, and mortgage rates are low. So in this process, we will try to do our job so that the housing market settles in a new place and housing and credit are available at normal levels. I think he talked about this in June, but it could have been before that. At that time, Jerome Powell told you to wait until the housing market reset before buying. The stock market plummeting isn't enough to bring inflation down. The housing market must also collapse for inflation to decrease, because the housing market has an effect on inflation. And before we continue, don't forget to subscribe to the channel, hit the like button, and turn on the notification bell to be notified every time a new video is uploaded. Let's return to the video now. Consider the following line, which I've highlighted in green. A 10% increase in housing wealth tends to correlate with a 1.1% increase in consumption. Conversely, a 10% decrease in housing wealth would be a 1.1% decrease in consumption. And a 10% increase in the stock market has almost no effect on consumption. So, if you're the Fed's chairperson or a member of the Fed's board, you know you have to manipulate the housing market down to actually get inflation out. And one of the simplest ways to get inflation to go down via real estate is to raise interest rates, especially if 10-year Treasury yields skyrocket. And that's exactly what the Fed is doing. Some of this may be due to quantitative tightening, some to market fear. But keep in mind that whenever the 10-year yield exceeds 2.75, the housing market suffers permanent damage, and it's currently at 3.57, which is quite remarkable. And if you look at the year-to-date chart, we are at the highest levels that we have been at this year. The longer we stay at these levels, the more long-term damage we will cause to real estate. The Fed wants to limit consumer spending by making people feel poor, which makes them spend less. This is more likely to happen if there are more ways to buy real estate for less money, but more money overall. When they spend less money and feel worse, inflation will fall and we'll be back to a normal sort of equilibrium, according to Jerome Powell. And that, in my opinion, will be the perfect time to go shopping for real estate. That's why we've got a real estate startup that is looking to maximize the opportunity of buying real estate once the pain and damage arrive. You may learn more about it by visiting househack.com. But first, let's look at some recent housing data to see where we are currently. I mean, has the housing market started to turn around? And what data was released this morning? Let's get started and then we'll look at the housing data to get a feel of what's going on in the housing market, based on figures released just this morning. Learn how to manage property rents and grow your money as a real estate investor. Rental renovations, where to save money, and how to save money are all things I've learned not just as a broker for over 10 years, but also as a homeowner with a property manager and in-laws who have been in the real estate market for 30 years, if not longer. We are very pleased to have you in property management, and there is so much wonderful material for you to learn from. Look at the links below, and you could even bundle them and apply that code because the price will rise at the end of the month when the offer expires. So what did we obtain in terms of numbers? Consider this. We have an intriguing duration here that we wish to comprehend. So the number of new houses increased, which is an exciting number as new development develops, but we need to dig deeper to understand. When we look at the data, we see that many of the housing starts were multifamily, which makes sense because rents are astronomical and continue to rise as people are priced out of being able to buy homes, putting pressure and demand on rents, causing more rental-based inflation. But it also makes it more desirable to build a multifamily building and rent it out if you are building single family. You're most likely selling them, and the stats don't look encouraging, which is understandable given that single family houses built by developers typically sell well this time of year. The period saw the lowest number of building permits ever issued. We predicted a decline of 4.8%, yet our performance was at least twice as good as that of the experts. Building permits actually decreased 10%, showing that builders are not happy with the changes coming to the real estate market. So the mood of home builders has been going down for 9 months, which is the longest drop since the tracking tool was made. Now that we can see some really intriguing things happening in the Redfin data center, what you want to do is Google Redfin data center, and I want to tell you how to do it so you can do it yourself. You should then proceed to the data center and uncheck 2020 once there because you don't need 2020. Therefore, 2020 may be excluded because it produces some strange curves and lines that don't make much sense. Instead, what we want to do is leap to median sales prices, where we can already detect a 4 to 5% moderation. We already noticed them, but the best course of action is to visit specific markets. For instance, let's visit Austin, Texas, where a 4-week moving average would indicate some discomfort, and a 12-week moving average might confirm that suffering smoothed out a little bit. Now is the time to change the value in the right box. Surprisingly, Austin's median home price declined from $554 from peak to trough. It's a huge decrease. Divide 516 by 554 to get the answer. This already anticipates a 6.9% drop in Austin, Texas, and their home values, meaning that we hit a peak in April. If I now go to the 4th week, you'll notice that the most recent data over here on the right isn't totally smoothed out, and the median sales price is $498. As a result, dividing the most recent closings by 498 suggests that Austin real estate is cheap and may already be declining as much as 10%, and you could do this in any area that you want. And that's all. I hope you enjoyed this video. If you enjoy similar stuff, check out my other videos, and if you like it, hit the like button, subscribe to the channel, and turn on the notification bell, and I'll see you in the next video.